Good morning. This is the Daily Intelligence Briefing for March 23rd, 2026. We have a critical situation developing, so let's get right to it. All right, here's our operational load map for today. We're starting with the escalating crisis in the Strait of Hormuz. Then, we'll dive into the domestic macro and political scene and some key moves in the corporate sector. We'll wrap things up with an editorial digest and the closing market numbers. Let's begin. So let's start with our lead story. The situation in the Strait of Hormuz, well, it's escalating, and it's escalating fast. Okay, let's break down why this is the dominant strategic story right now. Iran's military has threatened to completely shut down this strait. Not only that, but they've threatened to attack U.S. infrastructure if President Trump acts on his own threat to strike their power plants. This is all a direct response to a 48-hour ultimatum from Washington. And, the response back home was immediate. Prime Minister Modi convened an emergency security meeting to figure out what this all means for India. So why does this one strait matter so much? Well, typically, a full 20% of the world's entire energy supply flows right through this narrow channel. But here's the kicker. Traffic has already plummeted to just 5% of normal levels. That's not just a slowdown, that is a severe and immediate shock to the entire global system. And of course, the market reaction was instantaneous. Brent crude, which is the global oil benchmark, it briefly surged to $119 a barrel. That tells you everything you need to know about the anxiety over a prolonged disruption. You can see that anxiety spilling over directly into India's financial markets. In a single day, the Sensex just plunged, wiping out about 10 trillion rupees. At the exact same time, the India VIX, our fear gauge basically, jumped 23%. That is a very clear signal of major investor panic. So New Delhi's response has been purely operational, no big speeches. The focus is on the practical, nitty-gritty details, securing food and energy, making sure fertilizer is available, checking on coal inventories, and crucially, mapping out alternative sources for our imports and new destinations for our exports. And the really crucial takeaway here is this shift to a whole-of-government approach. This isn't just a foreign policy issue anymore. Nope. It's now about securing domestic supply chains and bracing for some serious financial stress. And that kind of pressure on the currency, it could seriously complicate the RBI's next move. Okay, now let's turn to macro, politics, and governance to see some of that domestic fallout. We've got 4 key updates for you here. First, the big theme on the macro policy front is that India is now officially in contingency mode. This is all about a preemptive effort to insulate the economy before any shortages actually become visible to the public. The focus is squarely on diversifying where we get things from and protecting our inventories across key sectors, everything from agriculture to power, especially after the disruptions we've seen to natural gas flows from Qatar. Next up, down in Tamil Nadu politics, we're seeing some very visible cracks in the DMK-led alliance, and this is just weeks before the election. The CPIM is demanding 6 seats, the DMK is only offering 5. Now, with this fight going public right after another ally already walked out, well, let's just say these negotiations have become incredibly delicate. Meanwhile, in Delhi, the Assembly's budget session is opening, but it's under the threat of a boycott. The opposition AAP is demanding that the suspension of 4 of its MLAs be revoked. But what's really interesting here is the timing. This whole standoff is happening just as key financial audits and the annual budget are about to be presented. And finally, a pretty symbolic political milestone. Prime Minister Modi has just completed 8,931 days in public office, and that sets a new record. Now, this isn't just a number. His cabinet is actively framing this as a sign of durable governance. So you can expect the BJP to lean heavily on this narrative of continuity and stable leadership. All right, turning to the corporate sector, we're seeing all these macro pressures starting to impact businesses in some pretty significant ways. First up, let's look at the financing for Tata's huge new semiconductor plant. It really reveals the playbook for India's chip ambitions. You've got nearly 7,000 crore rupees in debt, backed by some very strict covenants. But what's really fascinating is that the 163 acres of government-leased land was valued at 0 in the filings. So what does that tell us? It tells us the deal rests entirely on the Tata name and government support, not on traditional collateral. Next, the battle for Jayaprakash Associates is really heating up, and creditors are facing a very tough choice. On one hand, you have Vedanta offering more cash, over 6,500 crore, but it's paid out over 5 years. Then you have Adani. They're offering a bit less upfront, but they promise to pay it all back in just 2 years. So the dispute is no longer just about the final number, right? It's really about cash now versus more cash later. Here's a market that is on the verge of a massive shift. As the very popular weight loss drug semaglutide went off patent, India's regulator is now moving to tighten prescription rules to try and curb misuse. The potential here is absolutely huge. We're talking about a market projected to grow from $24 million today to $400 million by 2030. You can bet domestic drug makers are all gearing up to jump into this space. Electric two-wheeler makers are bracing for a real double whammy. Commodity volatility, which is being driven by the war, is hitting their margins at the exact same time the government's PM e-drive subsidy is expected to be withdrawn. This could push prices up by as much as 5,000 rupees. The big question is, will manufacturers absorb that cost, pass it on to consumers, or risk slowing down EV adoption altogether? And finally, there's a fresh governance issue brewing at HDFC Bank. After the chairman's abrupt departure, the CEO basically admitted it's really tough to calm investors down when the allegations are so vague and lack specifics. In a market this on edge, it just adds another layer of uncertainty that nobody wants. Okay, moving from the news to analysis, let's turn to the opinion pages. Raj Rishi Singhal has a piece on what he sees as a growing problem for India's economy: consumer rights. Singhal's central argument is really captured perfectly in this one powerful quote. He writes that delayed justice is, and I'm quoting here, no longer a technical weakness. It is becoming a broader rule of law problem that undermines both consumer confidence and India's credibility as a modern market. So the core of his argument is this: India's consumer economy is expanding way faster than the institutions that are meant to protect it. With the middle class set to grow to over 700 million people, the grievance system is just too slow and too understaffed. Get this, only 60% of state-level commission members have even been appointed. This isn't some niche issue. He argues it's a fundamental challenge to the rule of law. And let's close out with the verified market numbers. After a really volatile period, the markets did find some stability at the close on March 22nd. The Sensex closed flat at 74,532, and the Nifty did the same at 23,114. The rupee held steady at 93.71 to the dollar, but the number to watch for sure is oil, closing up at over $106 a barrel. And that really brings us to the clear takeaway from today's briefing. The conflict in West Asia is no longer a distant headline. It is actively shaping India's security, its economy, and its markets right now.